Thinking about investing? It can feel overwhelming. You've got some savings, maybe not enough for a house, but you know you should make it work for you. You hear about stocks, bonds, crypto, NFTs, fine art, watches. Where do you even start? It's a jungle out there. That's why today we're cutting through the noise. We'll dive into the top 5 time-tested strategies for building serious wealth, inspired by one of the greatest investors of all time. Warren Buffett didn't become one of the world's richest people by accident. His investment principles have created enormous wealth for decades. While they work for anyone, they're particularly powerful for those of you in the baby boomer generation, who have less time to recover from big financial mistakes. Unlike younger investors who can take huge risks and bounce back, boomers need strategies that protect their hard-earned capital while still growing their nest egg. Buffett's approach offers exactly that: a conservative, proven path to generating consistent returns over time. So, let's get into the first strategy. Buy great companies at fair prices. Buffett's #1 rule is brilliantly simple. He invests in businesses that have a strong, durable competitive advantage, what he famously calls an economic moat. Think of companies with iconic brands, incredible pricing power, or a business model that's just plain hard to copy. Instead of just hunting for the cheapest stocks, Buffett focuses on buying high-quality companies when their price is reasonable. This gives you investments that can weather market storms and keep chugging along, generating returns through good times and bad. As you get older, this strategy becomes even more crucial. When you're nearing retirement, you can't afford to bet on a struggling company hoping for a miraculous turnaround. The risk of picking a loser or overpaying for a stock is just too high when you have less time to make up for those mistakes. This leads us directly to the second principle: stay within your circle of competence. Buffett only invests in industries and companies he thoroughly understands. If he can explain in simple terms how a company makes money and what its competitive edge is, he won't touch it, no matter how popular the stock is. This simple discipline helps you avoid very expensive mistakes. It also massively reduces the stress of trying to figure out complex businesses in unfamiliar sectors. Think about it. Even Warren Buffett, with all his resources, stays away from areas he doesn't feel confident about. For boomers, this is golden advice. Stick to what you know. If you spent your career in manufacturing, you probably have a much better feel for industrial companies than for the latest biotech firm. Use your life experience as an advantage. The third strategy is all about mindset. Think long-term and let patience do the heavy lifting. Buffett often jokes that his favorite holding period is forever. He buys stocks with the intention of holding them for years, even decades. This allows the magic of compounding to work its wonders, building wealth slowly but surely over time. This approach means you have to resist the constant temptation to trade in and out of the market. Try to predict the next big crash or chase short-term fads. Instead, you buy quality businesses, and then you let them do what they do best: grow and generate profits. This is an incredibly powerful strategy for boomers because it removes the stress and high costs of constant trading. You don't need to beat the market every single day or worry about every little price dip. You just need to own good businesses and let time be your greatest ally. Now for our fourth principle, which is a cornerstone of protecting your wealth. Always maintain a margin of safety. Even when Buffett finds an absolutely fantastic company, he won't buy it at any price. He patiently waits for an opportunity to buy its shares for less than what he calculates their real intrinsic value to be. This creates a margin of safety, a financial cushion that protects him against unexpected problems. This could be a market correction, a business downturn, or some unforeseen challenge that hurts the company's performance. If you pay too much for even a great business, you can still lose money. For someone at or near retirement, this protection is absolutely vital. You simply can't afford to have a big chunk of your portfolio tied up in overpriced stocks when you might need that money for living expenses soon. A margin of safety is your financial seatbelt. Finally, The fifth strategy isn't just about investing, it's a way of life. Live below your means and reinvest the difference. Warren Buffett has always avoided high-interest debt and lived a life far more modest than his immense wealth would allow. As his income grew over the years, he resisted the urge to constantly upgrade his lifestyle. Instead, he invested the difference between what he earned and what he spent. This powerful habit does two things. First, it helps you avoid crippling consumer debt that eats away at your investment returns. Second, it means you're consistently reinvesting your dividends and capital gains, fueling the compounding machine we talked about earlier. This is especially important for boomers who have fewer earning years ahead of them to recover from overspending. To put it bluntly, every single dollar you save and invest today has a much bigger impact on your future than a dollar you might save years from now. So why do these 5 strategies work so much better for boomers? It's because Buffett's entire philosophy aligns perfectly with the needs of older investors. You need strategies that preserve the capital you've worked so hard for, while still providing growth. You can't afford the wild swings that come with speculative investments. Younger investors can take those big risks. They can throw money at crypto or the latest hot startup because they have decades to recover from any losses. A major hit won't derail their entire long-term financial plan, but boomers face a completely different reality. You need income from your investments to supplement your Social Security and pensions. You can't afford to wait 20 years for a speculative bet to maybe pay off. You need strategies that work reliably and protect the wealth you've already built. Buffett's principles aren't about getting rich quick. They are about getting rich for sure, and more importantly, staying rich. By buying great companies at fair prices, staying in your circle of competence, thinking long-term, demanding a margin of safety, and living below your means, you're not just investing like Warren Buffett. You're building a secure and prosperous financial future for yourself. Thanks so much for watching. I hope you found these strategies valuable for your own financial journey. If you enjoyed this video, please give it a thumbs up and consider subscribing to the channel for more content just like this. We'd love to have you as part of our community. See you in the next video.